First, with the good news, we've continued to see corporate America doing extremely well. Up until this point, we've had over half the S&P 500 companies reporting their Q2 results, and of those near 300 companies, over half, actually near 80%, have exceeded expectations. So corporate America is doing very well. Unfortunately, it hasn't exactly helped the stock market. The S&P, as we can see here from the first chart, has had a pretty rough week actually, down by about 3% over that period of time. In the context of this year chart, it still looks like a chart that's coming off the top, so nothing too dramatic, but nevertheless, what is overhanging this market is the negative sentiment around the negotiation of the debt ceiling in the US. Hopefully this is something that's going to get resolved as early as next week. Some heads to be banged together and hopefully to come up with a plan to resolve this debt ceiling. But whereas the market for a period of time running into this was relatively complacent about the debt situation being resolved well ahead of the August the 2nd as that date approaches, it is the overriding thing that's hanging on sentiment at the moment. So all of that good news of corporate earnings, I'm afraid, largely absorbed by this negative impact. And it is politicians fighting. This is not a situation that you could align with what's going on in some places in Europe at the moment, where clearly countries are running out of money. The US, of course, is in a much stronger financial position than that. So this is a political argument at the moment, and as I say, that is the problem, in the sense that it could run for a little bit longer. So, and as I say, at the moment it's the negative sentiment. What I do believe, however, is that as soon as it is resolved, I feel the positive sentiment will return as people reflect on the corporate earnings that we're seeing and the good results that are taking place. So in terms of the equity market, we've seen there, as I say, a 3% decline. Looking at the dollar, which is also another important barometer to sentiment, the dollar has been weak, as we know, relative to other currencies for a period of time. It's not having necessarily too negative impact in the currency markets this week. It's more an equity sentiment rather than currencies at the moment. The dollar there bumping along the bottom. And if we look at the bond markets, the US Treasury markets, again, there's been a little bit of softness in yields during the course of the week, as we saw yields pop up below 3%, but they're heading back lower again, and that for me indicates that the bond markets remain relatively benign towards this whole debt ceiling issue, which gives me further encouragement that, as I say, as soon as the situation is resolved, stock market sentiment will improve. Now, the situation in Europe, I'm afraid, I don't think has got much better since the resolution on Greece. We're already hearing that Cyprus needs bailing out. Now, while Cyprus is about a 15th or so of the size of Greece, so it's not a big number, it's going to be interesting just from a political standpoint, where the German finance minister was quoted saying that Greece was going to be the last of the bailouts. If Cyprus needs one, what are they going to do about it? So that has some interest going forward over the next few weeks as to, from a political standpoint. But the one we continue to keep an eye on is the Italian bonds, obviously a much bigger economy and a lot more debt involved there, and we saw bond prices really collapse here in line with Greece and concerns over the Italian situation through to the sort of mid part of July, and you can see there the rally that ensued post the Greek bailout. That obviously was a relief rally because it's resumed the downward trend, and I think that if we do continue to see further pressure on Italian bonds, potentially coming down to sort of new lows, I'm afraid to say that is a potential negative sentiment that will continue to overhang markets at that time. So that's something to be quite closely watched over the course of the next couple of weeks. There was a bond auction in Italy this week, and the yield on that auction was 5.77%. So these are quite high numbers. These are numbers that worsen the situation in Italy, and something that I suspect won't be going away in too much of a hurry. I want to finish on a positive note, however, and I do return to the subject of corporate earnings because for me that's the area that continues to impress. I mentioned the US corporate season that is going very well, and it's also going quite well here in the UK. Just wanting to highlight one stock which we've been buying over the course of the last few months, which is Pearson, owner of the Financial Times, a big business in the education market as well. And we saw this morning an earnings update from Pearson. They're raising their guidance towards the second half of this year, so analysts will be upgrading forecasts. And you can see there the positive momentum in the share price from Pearson, that big spike there, really in response to the upgrade. That's telling me that positive earnings surprises continue to benefit share prices. It tells me that analysts haven't got all the good news priced into stocks at the moment. So again, we've got to get through this particular black cloud, this particular storm that's overhanging markets, but underneath it, the sentiment I think remains quite resilient.